Let us now perform a number of other scenario analysis and also leave something for the future. The most simple one would consider the exercise we've already done. Namely, we had a stock market. The stock market had a highest raise of a stock price 5%, and the highest plunge that could happen was -5%. The stocks were invested at $10,000, and all these initial stock values were $10,000. So every stock received a equal investment. Now in here we had the percentages, by how much the stocks were going up and down. These used to be random numbers, but here we can see that now we calculated the stock price. We have those percentages, these random numbers. We are not going to go over all the details of the exercise, so you can go back and look it over, but here are the random numbers. So for instance, if we have the stock number 1 and we invested in it $10,000, then in period number 2 we changed the stock price by 2.8% in the green cell up in the upper table, and then we further changed it in the third period by 0.02%, and then we changed it further by 2.66% and so forth. So the stock usually it went up and down, and here it was. In the end, this first stock actually ended up in losses, and for instance this value for the fourth stock went just the same way. Now the sums for the entire portfolio, remember our portfolio consisted of 10 stocks, the sums were calculated up here. So in the beginning, since 10 stocks received $10,000 investments, in the beginning the stock portfolio was 100,000, and as we can see, it actually, all in all stocks together never got to a negative never got to the negative territory ever, and the entire portfolio ended up at 102,000, which is brought out in here. Now one thing that we want to do is we want to take these random numbers away. Right now they would be changing any time we change anything in the worksheet, all the random numbers would come anew. So there is actually one very useful tool, we'll be using it throughout the course, which deletes the formulas from such places, so that we will only be remaining with the values themselves, no more formulas. So for that, let's select the table, let's right click and copy, and now we are not going to say paste, but rather we will say right click, paste special, right click, paste special. And here we have a number of different options. For instance, we can copy the way the cells look, or anything besides the way the cells look. So everything gets copied, not the look, the colors and stuff like that. But there's a bunch of options, but the most important for us is going to be paste values. This only copies, this takes away the formulas from the cell. Let's click OK, and here it is. If before there was a random formula rand up here, then now it's only the percentage change. So in the case of the exercise before, we could, for instance, as we had random numbers here, we were kind of playing around with a hypothetical stock market. So we were looking at what the stocks would be doing. Now, if we don't have random numbers, this is actually a situation which we could arrive at, where we took these stock market changes from the internet, and these are now the changes the stocks undergo, and this is, let's say, some kind of a real stock market, and we know that if we start with such investments, we end up with 102,000. Now our question is as follows. Let's look at how this 102,000 is devised in this model. We click on data, sorry, formulas. We double click because we want to always have this at view. Let's go a bit lower. And now we take the final result. Here it is. And we start again. We start clicking trace precedence. You see, the final number comes from up here. Trace precedence comes from the 10 values above. Trace precedence comes from the previous period. Trace precedence from the 8th period, and so on and so on. So this is really the logic of how this worksheet is built up. And now what we want to do is we want to know, what if we needed to end up with 110,000, not 102,000 but 110,000? How much would we have had to invest initially in that case? Right now, investing 10,000, we ended up with 102. How much would we have had to invest for us to end up with 110,000? That's our question. That's another scenario analysis. So let's click on remove arrows. Let's remove them from here. And now let's try to do it. Let's go to the final value of the stock. And let's click on data, what if analysis, goal seek, set cell, and we're going to click on our final cell, set cell to value 110,000 by changing cell, and now we're going to change the cell by changing cell, and the cell where we will be changing is this $10,000. Okay. Let's click OK. And here it is. It turns out that if we invested 10,700 in each stock, or 107,000 all in all together in 10 stocks, we would have ended up, in case of this stock market, with $110,000. So that's what this stock market gives us. Another scenario analysis.